Welcome back to another episode of me sticking my nose into these charts every single day until I discover a trade model that makes me millions and millions of dollars. And in today's price action, it did the exact opposite of what I expected to do, which is perfect because I can go in hindsight, and backtest every single little fluctuation in price and figure out exactly where I went wrong and exactly why price behaved the way it did today. So I am grateful that price did the exact opposite of what I expected to do. When something like this happens, there's two ways you can look at the situation. Number one, you can look at it and think, oh, well, that sucks. I'm shit at reading price action. I should probably quit trading. Or number two, you can look at this and think, awesome. Now I have the opportunity to figure out exactly what I did wrong and become a better trader because of it. So it's all about perspective. You got to shift your perspective, change the way that you look at things, right? There's a positive in every outcome. It doesn't matter what it is. And if you only focus on the positive, then it can only be a positive. And so I'm only going to focus on the positive in this situation because I am clearly a better trader because of this. So I'm going to jump right into this analysis. I'm going to try to keep this one short. Basically, on the weekly chart, this is what we did in last week's trading. We have this discount wick. We have a buy side imbalance, sell side inefficiency. How far can price trade down into this buy side imbalance, sell side inefficiency? Well, we have this wick. This is also an order block. So price can reach all the way down into the weekly order block. That is where we are expecting price to trade down into this range of the buy side imbalance, sell side inefficiency. Now going to the daily chart, we see price react perfectly exactly how you want to react off of that weekly order block. It comes down there quick and repels it quick. Comes down in 1-2 days, boom, trades off of it, moves higher. That's exactly how you want to see it react to a bullish order block if the order flow were to be bullish. And it's also trading into this buy side imbalance, sell side inefficiency. So now this is rebalanced, and there's no reason for price to come back down here, or at least that's what I'm thinking. So initially coming in today, my bias is bullish, but obviously that did not play out today. And we also have this large pool of buy side liquidity that is yet to be tapped on the higher time frame. So retail sees this as an area of resistance. They're going to place all their buy stops above that level. There's also a strong reason for the market to drop in there. But obviously, that did not happen. The exact opposite happened. We just, boom, ran through everything. So why do we run through everything? Well, you have to weigh in all the different PD arrays that you see on the daily chart. Now, what held down price today and acted as the high of day? This propulsion block. We can see that we have a propulsion block here. We have this highest up close candle. Close over the open price of that. Violate this up close candle. That makes it a bearish order block. And what do we have formed off of that? We have another up close candle that trades up into this. And that open price is also violated. So that makes this a propulsion block. And when price tests the open price of a propulsion block, you want to see a boom react off of it real quick and send price lower, which is exactly what it did today. So when you are doing your analysis on a higher time frame, you have to weigh out all these different PD arrays and grade the strength and weakness of the market. Obviously today price opened up near this propulsion block, traded higher, creating the Judas swing, rejected it, worked off of it, and then boom, look what we see as a result. So initially I did come in today thinking higher, but clearly did not pan out today. So dropping down to the 15-minute, this is what I was anticipating. Now, the first mistake I made is seeing all this sideways price action and thinking this is the terminus of this price run. When what we are seeing clearly is a classic sell day profile. We have an Asia range, we have a London manipulation, and then we begin to distribute lower. So what can we anticipate? We can anticipate New York to be a continuation down because the London session forms the high or the low of the day 70% of the time. And if we also study how price reacts off of the daily PD arrays and also all of these layered new week opening gaps and new day opening gaps, we can grade the strength and weakness of the market. I mean, look at the reaction to the propulsion block on this 15-minute high right here. Trades right up into it and rejects it. And what else do we have here? We have these layered, all these new day opening gaps, new week opening gaps stacked on top of each other. They're going to act like a spider web. They're going to catch price in its web. They're going to trap it. They're not going to allow it to go higher. So if price does not show ability to slice through all these layered new day opening gaps, new week opening gaps, and it cannot get above it, that is also a clear indication of weakness. Now combine that with the daily propulsion block, and you have a high probable trade scenario or something to frame the narrative for the day. And if we're seeing this If we're seeing this price action inside of the layered new day opening gaps, new week opening gaps, and the propulsion block, and we can see that we have a classic sell day profile, well, that would probably invalidate the bullish bias on the day. But this is all in hindsight, of course, and now I learned this lesson. And I see all this momentum coming down off of the London high. So we have a really large run off of the London high. Now here's also something that I have to weigh in. Look how price is trading. Look how close price is trading to Friday's low at the 9:30 open. It is only trading within 100 handles of Friday's low. Now, think about this. Is it more reasonable for price to trade to reverse, inverse all of this, and all of this, work through all of that, and trade up into the pool of buy-side liquidity, which is over 200 handles away? Or is it more likely to draw down into Friday's daily low after we see a classic sell day formation, after we see price struggle to get through the spider web of new day opening gaps and new week opening gaps and work off the daily propulsion block? What's more probable? And looking at the order flow on the 15-minute chart, you can clearly tell that it's bearish. Look at all the breakaway gaps that we have where price is so heavy that it does not even reprice to any of these imbalances. Now, of course, we reprice to this imbalance, but look, we can't even trade to consequent encroachment of this 15-minute buy-side imbalance, sell-side inefficiency. So what does that indicate? Clear weakness. And what do we have here? A high, a low, a higher high, and a lower low. So what does that make this? That makes that your bearish breaker. And do we stay in the lower half of that? Yeah. So what does that indicate? Weakness. Now what do we have right here? We have an old low. So an old low that is taken out with an imbalance, that makes that a premium array. And look how price respects that. So we're trading into this 15-minute buy-side imbalance, sell-side inefficiency. We have this old low that is now a premium array because it's been inverted. We have the breaker. So all three of these PD arrays converging in one area. And that is after we see this action at the high of the day in the London session off of the daily propulsion block. So if I drop down to a lower time frame and study that price action even more, look how the bodies of the candles, when we trade above it and fade back under it, notice how the bodies stop right there. Here we color outside the lines a bit, but look at the wicks right here. Boom, boom, boom. And look how we wick off of that, and then boom, breakaway gap. Don't trade into this. That's another breakaway gap. Breakaway gap, breakaway gap. So the order flow is clearly heavy, and this propulsion block is acting like a propulsion block. It is propelling price lower. That's exactly how you want to see it work. And notice the inability to work through the spider web. This is the spider web. Can't get through it. So if we cannot work through this, that is indicative of weakness. And we're working off the daily propulsion block. That is indicative of weakness. And look how we're manipulating the Asia high first. That is the first thing we do. So getting a bias, deriving a bias is exceptionally easy. You literally just look for what side of the marketplace does price take first, because the second side is going to be the further move, the larger move, and that is going to be your bias. And you can clearly see that we have the Asia range right here. So what is the first thing that we do within the daily range? We trade higher. This is the Judas swing, the fake move for the day. And we run the Asia high. So the first thing that we do is run buy-side liquidity. So what's next? The other side of the marketplace is it. Tag your it. We run the buy side, sell side's next. Sell side is it. And then here's how we react off of that old low on a 15-minute chart. We can also see on the 5-minute chart. We literally wick off of this low. Right here, we test it to the tick. What are the coordinates on this? Make that straight. Okay, never mind. It just wasn't straight. Okay. But anyways, look how the bodies cannot close above the old low. So it is now a premium array. We cannot close above it. We have this sell side imbalance, buy side inefficiency inside of the 15-minute sell side imbalance, buy side inefficiency. And look how we work off of consequent encroachment here. That is perfect. So not only can we not trade to consequent encroachment at the 15-minute buy-side imbalance, sell-side inefficiency, but we also can't close above consequent encroachment of the 5-minute SIBI, and we can't close above the old daily low, and this is all inside that breaker on the 15-minute chart. So what else do you need to see? Nothing, literally. You don't need any other context to put on a trade here. And look at the reaction that we get out of this. We have a breaker formation. We have a high, a low, a higher high, and a lower low with meaningful displacement. This is inverse. Now, of course, price refers back up to that. And boom, look where the body stop. That is perfect. That is everything you need to see. Now, another thing that I noted when I was reading price action, I was looking for something to get long off of, and I was looking at this range. You can clearly see that we have a consolidation range. So whenever we see a range, it's just like it's exactly the same thing as what I outlined earlier. What side of the marketplace does it take first? Because the second is where there's going to be that more meaningful move, a larger move, a longer move, and the second is the real move. The first is the fake move. Whatever they run first, that's the fake move, the Judas swing. But here we have this consolidation range. What do we take first? See, here's pool of minor buy-side liquidity right here in this blue line. What do we take first? Initially, we break out to the buy side. We take the buy stops first. So what's next? The sell stops. And look at this. Look at this beautiful trend line. Isn't that beautiful? Beautiful trend line of support just gets absolutely ran over right at the 9:30 open. So when we see this breaker formation, we see all this information up here indicating weakness. The bodies literally cannot even close inside of the 15-minute imbalance, the 5-minute imbalance. Can't close above that old daily low. And it's all rejecting the breaker on a higher time frame. We close outside of all of that. We can't even close above the old high. We can't even close above this high. So that is all indicative of weakness. That is clearly weak. We're breaking out of the range, taking the buy stops first, and then I see this, right? It's everything that I need to see. This is my optimal trade entry. Wait, is this an optimal trade entry? This is my optimal trade entry, but is it the optimal trade entry? Of course it is. Look at that. So this is literally everything. This is a very, 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 very high probable sell scenario that I see right before the 9:30 open. So if I see this before the 9:30, I'm easily taking this thing short. Now this is all in hindsight, of course. In the moment, I was looking for something to get long off of. I actually tried it short somewhere down in here and hypothetically stopped out because I sold way too far on a discount, which I'll break down on a 1-minute chart. But here's the 5-minute analysis. I don't even need a 1-minute chart to get short on this. And I could place my stop loss probably above consequent encroachment of this premium wick. And that would be it. And the work there is beautiful. And it just dies. Literally the rest of the entire session. So there's the analysis on the 15-minute, the 5-minute. Now if I drop down to the 1-minute, everything is just amplified even more. Now dropping down to the 1-minute. We can refine this even more. Look where the body stop. So here's that old low. I'm gonna mark this in red. So here's that old low that you can clearly see on the 15-minute chart. Look where the bodies stop. That is precision. That is perfection. You can't get any better than that, literally. And so what do we see on the 1-minute time frame as well? We also see a breaker. Here's your breaker candle. Do the bodies ever close above this? No. We have a change in the state of delivery. Here's this order block. We never close over mean threshold of this order block. Boom. Look at that. That's precision. We have this sell side imbalance, buy side inefficiency. Never can close above that. So that tells you the narrative right there. Although we do see some coloring outside of the lines, we never ever close above or outside the 1-minute imbalance as well. So we're closing below the imbalance on the 5-minute. We're closing below the imbalance on the 15-minute. And on the 1-minute, we're closing inside of the the 1 minute imbalance. So the order flow is clearly bearish, trading back into this area where you have all these converging PD arrays, where initially we see price break out to the upside and run the buy stops first out of this range. After seeing all this work done in the London session. So if I see this kind of work done in the London session, when we're seeing this inability to trade through the spider web, seeing the work off of the daily order block, seeing us manipulate the Asia range, and I see this is the order flow on the 15-minute chart. This is super, super heavy. And all this is just engineering low resistance liquidity. I'm looking to get on side with that move in the New York morning session. So in the New York morning session, I have the benefit of knowing what happened in the London session. I can use that to derive a bias for the day, which was very applicable here. I just was too worried about longs, too focused on longs, because I'm still learning how all these pieces go together, really. I'm still only about 2 months into studying ICT. And if we go back to the 1 minute, what do we have here? We have this inefficiency. And we can see how we trade up to consequent encroachment and reject that perfectly, beautifully. Look at that. So where could I have sold short on this trade? Well, if I was aware of the 5-minute breaker, I think this would have been a perfect entry right here. This would have been my ideal entry in a perfect world. Right here. Which would essentially be maybe the low end of this, and I could probably use the high end of it as a stop, targeting first partial here, which is also a daily volume imbalance. All of this low resistance sell side liquidity, it's all taken out with one swift run. And post 9:30, there was multiple opportunities to get onside with this move. And you can tell that the market is clearly weak because we don't even trade to the opening range gap at all. Literally. 9:30 opens, boom, off to the races, take off. Don't even refer back to this thing at all. That's how you know the market is clearly, obviously heavy. Very, very heavy. It cannot even reprice to consequent encroachment of the opening range gap. So we have a 70% chance that the market's going to trade back to consequent encroachment of the opening range gap. Here, we can't even do that. So what does that tell us? Price is super, super heavy. And this literally led to an all-day sell day. So that's another good piece of information, good piece of intel that I learned today. And then here's another opportunity to get short on this move. Post 9:30, literally just leave. We tap into Friday's low. Now, when we approach a daily low, we're not just going to boink, have a little shallow run on it. No, we're going to accelerate through and below that low, especially on a day like this where you have a classic sell profile, because they're going to want to run all the sell stops underneath that daily low. So initially, you could probably just view this as them thinking retail that this is an area of support just to trap more longs into the market, lure more longs into the market, engineer more buy side liquidity. Have retail thinking a bottom is in because we come back and test this level of support and we begin to move away from it. Then might have people thinking a bottom is in. Now, if I'm being honest, I was looking for a long down here. But clearly on the 15-minute time frame, I was looking at the higher time frames, the 15-minute, the 5-minute, and nothing ever changed on the higher time frame. The order flow remained heavy the entire time, so there was absolutely nothing for me to do. So a good thing about today is that there was nothing for me to do, so I sat still. I didn't record any more observations after that because I was looking for longs and there was no long scenario. So that's a good thing about today, is I knew that the order flow in the higher time frame was clearly weak, very, very heavy. So I never even tried a hypothetical long. So that was perfect. That was good. But in this situation right here, because look at the work off of consequent encroachment of that daily volume imbalance. Boom. Perfect. And what is this? A breaker. Every down close candle that sees a break to the downside is a breaker. Do the bodies disrespect it? No. What do we have right here? An order block. Right there. Do we close above the mean threshold of the order block? No. What does that indicate? Weakness. What do we have right here? An imbalance. Can we fill it in? No. Do we close above it? No. We don't even close in the lower quadrant. We wick through it, which is reasonable because we have first presentation above it. Look how we wick into first presentation and boom, immediately come off of that. So here's another perfect opportunity to get short here. And now we have a propulsion block right here. So this is a valid propulsion block because we do not close above the mean threshold of this order block. So this becomes a propulsion block. And seeing all of this action down right here, all this action in here, I could probably take a short off of the propulsion block if I don't get my entry here, which would be right there. And does it propel price lower? I would say so. Boom. Never looks back from there. So the entire time, the order flow remained heavy, remained bearish, and there was no reason to get long in this thing. So when I first started recording my observations and hypothetical trade scenarios, I would not have any affinity of what that higher time frame is doing, and I would constantly try to fade it, and that would lead to a lot of wrong, incorrect observations or hypothetical trades, because what I see on the lower time frame, see, it looks like if you're looking at the 1 minute right here, let me just pull up a 15-minute next to this. This was at that 10 a.m., right? So if you're looking at a 1 minute time frame right here, I think it's this area, right? Yeah. If you're looking at a 1 minute time frame here and you're a retail trader, you're probably thinking, oh, this thing is putting the bottom. We're starting to see a rally up. Let me get long on this. But if you know how institutional order flow really works, you look at the 15-minute time frame and see that we have not yet seen a change in the state of delivery. This thing is still in a sell program. It is aggressively pricing and drawing towards Thursday's low, which is the previous week low. So it is aggressively seeking that liquidity out, and there is no reason to be long. This up close candle that we see is simply a bearish order block forming, or the algorithm referring to premium arrays on a higher time frame, which is the same thing that we saw here at this 11 o'clock candle. Now, I'll be honest, I saw this up close candle right here, and I'm thinking, okay, maybe could be a long scenario here because this range was larger than any other range in the vicinity, in the nearby area. So I'm thinking maybe something has changed down here, but if you look at the 15-minute time frame, what is it simply doing? It's simply trading higher to refer to the inefficiency on a 15-minute time frame. So don't get tripped into a long just because we start to see this on the 1 minute time frame. You have to see what is that higher time frame doing. You can see that the order flow is clearly heavy, clearly bearish on the higher time frame, so I'm not looking to get long in this thing. So I was kind of looking for a trade scenario in here, but I thought, no, this is just the algorithm referring to that imbalance on the 15-minute time frame. And we'll probably tap into this 15-minute imbalance and then trade lower, attack Thursday's daily low or the previous week low. That's what I put down in my notes, and that actually played out. So good job on that. Tapped here, and then boom, delivered to the low, as I anticipated. But this was kind of trading to the lunch hour, and I don't really stay that long, so we just turned off the charts and called it the session. So learned a lot of things today. I learned, number one, reading that higher time frame order flow. If it's clearly bullish, if it's clearly bearish on the 15-minute, and nothing has changed. When I say nothing has changed, I mean there's no change in the state of delivery. As long as I don't see a change in the state of delivery, then I have to trade with that higher time frame order flow, and I should not look to be on the other side of the marketplace. That is just absolutely stupid. There's no reason to do that. So until the state of delivery changes on that 15-minute time frame, then I have to trade with the higher time frame order flow. Number two, I learned about perception of days like this where you don't have a good read on the market, or you come into the market. It's not that I didn't have a good read on it. I knew what the order flow was telling me. I would just expected the opposite and didn't deliver that, which is okay. It happens. So I learned about having a positive perspective on the outcome of your trading session. It can do the exact opposite of what you want it to do. You can think that you can feel shitty because of that, or you can think, this is awesome. I have a lot of opportunity to learn and grow as a trader. And I also learned, number three, what a classic sell day profile looks like, and that in the London session, right? I learned how to grade the relative strength and weakness of the market by studying pertinent PD arrays such as the new day opening gaps, new week opening gaps, and daily PD arrays. So all this information right here indicated clear weakness. And yeah, I think that's all I learned. See ya.